Europe is on the edge of recession, with major economies slowing down and Germany already contracting. Falling real wages across the continent, compounded by fiscal austerity, are dragging down its growth. China, though showing signs of recovery from last year, faces weak domestic consumer demand and private investment. China, however, has more fiscal policy space than other large economies to address these challenges. But despite all this, the United States economy has amazed everyone through its measured economic slowdown. However, the recent report warns of investment concerns, especially due to the ongoing high interest rates. Growing inequality, weaker growth, and the widening wealth gap further threatens to undermine the fragile economic recovery and the aspirations of nations to meet the Sustainable Development Goals. Over the past 12 months, the total personal consumption expenditures (PCE) prices rose by 3.5%, and excluding the volatile food and energy categories, the core PCE prices rose by 3.9%. And to better understand core inflation trends, it is best to look at three large categories that together make up the core PCE price index, because what has been causing inflation in each of these sectors is somewhat different. The first category is core goods inflation, which has slowed dramatically as supply chain-related price pressures continue to ease. The second category is housing services price inflation, which has finally started to cool off as expected, given the earlier slowdown in rent increases for new tenants. Unlike core goods and housing services, core non-housing services have not yet shown a significant slowdown in price increases. Since this segment accounts for more than 50% of the overall core PCE index, more slowdown in this area is needed to meet the desired inflation target. Despite the strong labor market, the gap between labor demand and labor supply is narrowing. This is because labor demand is slowing while labor supply is increasing. And with consistent declining labor demand, job openings have declined by nearly 1 million from the end of January to the end of August. Nevertheless, job openings remain about 30% above their pre-pandemic level. At the same time, layoffs have remained very low, and total non-farm payroll employment rose by 336,000 in September, above the average monthly gain of 267,000 over the prior 12 months, and the unemployment rate was unchanged at 3.8%. Improvements in labor supply are also contributing to rebalancing the labor market. For instance, since the start of the year, the prime age labor force participation rate has moved up further. Immigration has also picked up, further contributing to the increase in labor supply. The major labor market indicators from the household survey remain largely unchanged in the past month. Similarly, the unemployment rate remained at 3.8%, and the number of unemployed persons remained essentially the same at 6.4 million. September saw little change in the number of long-term unemployed, which remained at 1.2 million. These individuals, who have been jobless for 27 weeks or more, make up 19.1% of the total unemployed population. Despite wanting to work full-time, 4.1 million people are stuck in part-time jobs. Their hours had been cut, or they couldn't find full-time jobs in the first place. Either way, they were trapped in a cycle of underemployment. The leisure and hospitality sector added 96,000 jobs in September, above the average monthly gain of 61,000 over the prior 12 months. This is a sign that people are eager to get out and spend money on travel, dining, and entertainment after 2 years of pandemic restrictions. The government sector also added 73,000 jobs, above the average monthly gain of 47,000 over the prior 12 months. This growth is being driven by hiring in state and local government education. The healthcare sector added 41,000 jobs in September, compared with the average monthly gain of 53,000 over the prior 12 months. Overall, the U.S. job market is recovering steadily, with all major sectors adding jobs. However, the leisure and hospitality sector is leading the way, with the most robust job growth. There are also important downside risks to economic activity, such as the slowdown in foreign economic growth. China's economy appears to have lost momentum as real estate activity has fallen, and other indicators including retail sales also suggest softness in economic activity. The manufacturing and services, purchasing managers' indexes (PMIs) in Europe have recently fallen into contractionary territory. This means that the majority of businesses in these sectors reported a decline in activity compared to the previous month. These developments may have implications for the U.S. economy, especially if conditions deteriorate sharply abroad. This graph illustrates how long-term interest rates move in anticipation of changes in the federal funds rate. The red line is the average long-term BBB corporate bond rate, a measure of corporate borrowing costs. The blue line is the average 30-year mortgage rate. Notice that both measures increased in early 2022 in response to Fed communications. Recently, these long-term rates have increased further. More generally, financial conditions have tightened further and real long-term Treasury yields have risen significantly. There are factors that could weaken or delay the transmission of monetary policy. One such factor is that the bulk of corporate debt issued by large firms has not yet refinanced since the FOMC started to tighten monetary policy in March 2022. Large businesses rely on corporate bonds and bank loans as sources of debt financing. Corporate bonds tend to be fixed-rate debt, while bank loans tend to be floating-rate debt. As most non-financial corporate debt is in the form of corporate bonds that were issued before 2022, the interest rate average across all outstanding corporate debt is still low. This rate will likely increase next year when a larger fraction of maturing corporate bonds needs to be refinanced. A rule of thumb definition for a recession is 2 consecutive quarters of declining GDP, which did occur last year. Another key indicator is an inverted yield curve, when short-term rates are higher than long-term ones, which has been the case since 2022. Yet, for now the economy is more resilient than expected. Gross domestic product grew faster than anticipated in the second quarter at 2.1%. From August to September, the average hourly earnings increased by just 0.2%, a slower growth rate than anticipated. Despite all of that, Americans are still opening their wallets. Consumer spending, which represents about 2/3 of economic activity in the U.S., rose by 0.4% in August after July's 0.9% increase, which was the largest in 6 months. But some warning signs are flashing red. Prices at the pump are part of what's keeping inflation persistent. Oil prices reached a 2023 peak last month, and the average price for a gallon of gas is about $3.72, though it has steadily fallen in the last few weeks after hitting an 11-month high on September 15. The global nonprofit network United Way supports 211, a phone line that connects millions of people in need with local resources like food assistance programs and support for housing. The nonprofit says the calls reached their highest level in August, a majority of which were for utility payment assistance and housing-related requests. Credit card debt topped $1 trillion for the first time on record, plus, borrowers have the added pain of student loan payments coming due this month. Oxford Economics estimates that the resumption will result in a roughly $105 billion reduction in consumer spending. Economists are now divided on whether the U.S. economy will enter a recession this year or next, or if the Federal Reserve can achieve a soft landing, where it brings down inflation to its 2% target without inducing a recession. The good news is, rates may not climb much higher, and the downside of the economy's strength is, we are likely to see rates remain higher for longer than previously expected. Those on both sides of the equation agree that whether there's a recession or not depends mostly on the consumer.